big drop in taxation this quarter. Can you throw some light on that?
No, here, if you look at it, standalone, we are falling under MAT because of the carry forward MAT credit. The effective tax rate it is in India is working out 7.75 to 70%. And as you know that in Vietnam it is the tax free, corporate tax is completely exempted. Thereby you could see that a drop in the overall effective tax rate. And as I informed earlier also, the effective tax rate at group level, it is around 12%.
Okay. Thank you so much, sir. That is it from my side. And all the best.
Thank you very much. The next question is from the line of Senthil Manikandan K from iThought PMS. Please go ahead.
Good morning, sir. Thanks for the opportunity. My first question is with respect to the vending machine business. So if you can just share what's the broad strategy behind over the next 3 to 5 years in building this business in the domestic market.
So, vending business, we approximately today have 4,000 vending machines that are operational across the country. And we are looking to build aggressively. See, this is a very, it's a tricky business as well because vending machines, everybody in the market wants you to put, without any cost, and then they might end up also buying from somebody else once they get the machine, because obviously there will be local players and traders who probably offer at a very dirt cheap rate and things like that. So that is why we have been very careful on this front, not to go overboard. Today we are making sure that it's a self-sustaining model. In 6 to 7 months, most of our vending machines kind of pay back for themselves. So keeping all this in mind with the new approach, we are looking to scale it up, and but in a more sustainable manner. In terms of the business that it will generate, of course, we're looking to build up a business out of vending itself to 100 crore kind of a business in the next 3 to 5 years. Today it could be around 20-25 crores or so. But yeah, that's been our plan and that's been our strategy as far as vending is concerned. In fact, last time we had also kind of apprised all of you that there is this whole out-of-home consumption that we want to tap into and drive this whole out-of-home consumption a lot more deeper. And there are certain experiments that we have been doing. We have been, opening kiosks. We are about to open some cafes as well, and do the proof of concept of, penetration driving as far as the cafe concept is concerned. So all that work is happening as far as the out-of-home consumption is to be given.
Okay, sir. Thanks. Second is a related question on the domestic market in terms of our presence in the coffee retail chains. So of late, we have seen that a lot of startups like Third Wave Coffee or they're making a good presence in the market. So what's our presence and strategy in this area of business?
So, I'll just give you a brief background. As far as all the coffee startups today, if you see the India ecosystem, as far as coffee is concerned, probably a large part of it is driven by us. So a lot of these coffee D2C brands and these startups you see, whether it is brand or whether it is the chains, we are doing a lot of back-end work with them to drive, because our whole concept has been that how could we drive a lot more coffee consumption in this tea drinking country. Yeah. So that's one. Second is in terms of our presence. If you see, our presence far outweighs all the brands, in fact, put together. Most of these D2C brands are probably in the range of 25 crores or so. And we are probably will be reaching 200 crores this fiscal. So you can kind of, compare the kind of presence we have. So if you come to, south of India, and if you start going to retail outlet, you'll see that our presence is as a very strong number 3 brand in most of the retail outlet. And there are certain pockets where we are, seen as a number 2 brand. So that is the kind of, presence and visibility that we have been able to achieve. Yes, the next milestone would be to get this kind of presence and visibility in the North, East, and West markets as well, for which the work has started. There are a lot of outlets where we are now fairly visible in these zones as well. So that's a brief outlook of our presence in the retail market.
Okay. Yeah. Thanks for the answers. That's it from me.
Thank you very much. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Hi. Thanks for the opportunity. Just a clarification, when you're talking about 200 crore of brand revenues this year, does that include the vending machine business also, or if not, then?
Yeah. It includes branding business, because all the vending machines is a branded these things we all sell under the brand. So that is part of the brand. Bulk and private label is outside this.
Okay. And out of 200, how much will the vending machine business be by the end of the year?
Approximately 20-25 crores would be that. The rest of it would be products.
Okay. And then in terms of the product, as you were describing, that you are either number 2 or number 3 in most of the southern part of the country. So my question is that how is the competitor, the leader or the number 2 player reacting on the ground to your surgeons in those particular markets? Are they trying to dislodge you by discounting, or what's going on? If you can just give some commentary on that.
So, we are fighting against, the top 2 multinationals of not the country, but of the globe. And obviously this thing would be to be aggressive. They hate to lose market shares. But, what we are doing is we are constantly focusing a lot on consumer offtakes. Because once the offtake starts happening, it becomes really difficult for you to be, even if you're very aggressive in terms of doing channel discounts and maybe consumer discounts. Once you are building loyalty for your consumers, what happens is that that ability for your competition to kind of bring you down that much reduces. So that is why we are doing a lot of activities in terms of building consumer loyalty. We are doing a lot of ATL activity combined with a lot of sampling that we do on ground, which is making a huge consumer base for us. In fact, one of our largest selling packs is the 200-gram pack, which is not the largest selling pack of the category. So that gives us an indication that we are building a very strong consumer base, and that is helping us ward off all the competitive pressures that may be coming from the competition. But yes, competition has been reactive. They are doing a lot of things. But consumer is the thing that we are focusing on, and we think that we are doing the right thing. As long as the consumers are picking up your brand, I don't think so any of the pressures would kind of work.
Got it. And then just a quick follow-up on the online side. How would you rank yourself, and who are the what is the market share that you would ascribe to ourselves vis-a-vis these 2 large players or other D2C brands that you were talking about earlier?
No. Come again. On which side did you say? Online side.
On the online channels, yes.
Yeah. So of course, online channels, again, we are very, very sustainable on that. Today, if you see the online channel, there are 2 sets of products that sell. There is one set of products which sell because there is an offline equity that is getting built for the brand. So that if you see the large players and including us, which is Nestle, Unilever, and Continental, I can count it now in the same basket. Our online sales are largely dependent on the offline equity that we are building. But if you see the D2C brands, their online sales are largely from the huge amount of money that they have to spend online itself. So therefore, you see it is becoming very, very tough for each of these brands to sustain the online sales itself. And if you were to kind of search for the ROC data for some of these D2C brands, you will yourself see the kind of losses these brands end up making. So anyways, I don't want to go into that side, but that's been our strength. We have been very strong on online. But the good part is that I spend 1 rupee to get 3 rupee revenue in online. Whereas most of the D2C brands, if you see the D2C ecosystem, their ratios have been upwards of 1, which means that the profitability really gets reduced. So that's been our strategy. We are very focused on online. Today, almost 10% of our sales, which is approximately, out of 200 crores, 20 to 25 crores is coming online, which is equivalent to some of the large D2C players who are much talked about in the market. But yeah, the only difference is that we don't go tom-tomming about it. And the second thing is that we are building it very sustainably.
No, that's wonderful. Thank you for all the commentary. Just one follow-up. Do you have any market share data on the online side? Like, where would you stack up among top 5, top 10 players?
Very difficult to get online market share data because, yeah. But our sense is that, from whatever talks that we do to with the category managers of the online space, we probably would be close to around somewhere. My sense is that 8 to 10% could be our share in the online space that we are into.
Great. Thank you so much, and all the best.
Thank you.
Thank you very much. The next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good morning, management, and thanks for the opportunity. My first question is it possible to share what is the gross margin and advertising spends in the branded business?
On a broad level, the gross margins would be in the range of, so the domestic market, we look at it as a whole, it's approximately 30%. The brands would be 5 to 7% higher. And our advertising to sales spends is roughly around 8 to 10% as of now. So that's the ratio on the advertising spends. Yeah.
Okay. And as you scale up your branded business, is there a plan to sort of separately list also that entity? Because essentially now that it is part of the B2B business, it may not get fully valued. But once scalable, is there a plan? And if there is a plan, at what level would you be looking to execute that plan?
So as of now, we want to kind of, in fact, it was under a separate subsidiary which we kind of demerged it back to the parent company because the leverages are much better for us to drive when you are doing it from the parent company. So we really want to go very strong on this segment, kind of build this segment over a period of time. As a vision for the company, we have already kind of earmarked that CCL going forward next 5 years, 10 years, 15 years should kind of transform itself into a true blue FMCG company with a lot of brands getting launched and a lot of brands getting sold. So that's our vision, and we want to kind of translate this vision from the parent company itself. So that will be a strategy. So in the short and medium term, I don't see any such kind of an effort from our side.
And sir, in terms of debt, we have a debt of about 1,000 crores on the balance sheet. When do you plan to become debt-free?
It will take around 3 years or 4 years from now to completely become debt-free. But that's it's a little hypothetical question because as we move along, as the growths are coming, we really don't know when the next expansion is going to come. But if suppose we were not to expand and there is no new capex that is going to come our way, it will by 28 or 29, which is now 4 years or let's say 4 years from now, we should be debt-free.
And so lastly, what would be the share of China in our overall revenue pie? And do you think that number can significantly grow from here on?
Very negligible right now, very minute quantities we sell right now. But last time we had indicated to you that we are kind of partnering with one of our old associates and we are building that market. So that market right now is in the seeding phase. So right now there aren't any significant volumes that are coming. But we expect these things to pick up as we move along and we'll keep you updated as the volumes pick up from that geography.
Okay, sir. Thank you and all the very best.
Thank you.
Thank you very much. The next question is from the line of Dhruv Bakhai from RSPN Ventures. Please go ahead.
Hello. Thank you for taking my question. So can you throw some light on quarter-on-quarter and year-on-year figures of EBITDA per ton and the overall capacity utilization that you have been able to achieve?
I'm sorry, I'm not able to hear you clearly. Can you just repeat?
The quarter-on-quarter and year-on-year figures for EBITDA per ton and the overall capacity utilization that you have been able to achieve.
So EBITDA per ton, it remains exactly the same as before. There is a little drop in quarter three because we were selling a little aggressively. But, as we had explained earlier, that the spray-dried EBITDA per ton is approximately 90 to 100, and the freeze-dried is around 130 to 135. So that remains intact. As far as capacity utilization is concerned, the India capacity is fully utilized. And when we say utilized, obviously it won't be 100% of the rated capacity. It's generally at closer to 90% or so because of the changeovers, because of the kind of blend that you are doing. So India capacity is fully utilized. Vietnam is also, last quarter we did the optimum utilization of the capacity. There are, it's a new capacity. There are certain line balancing and all that is pending. But, barring that, we did optimize fully the Vietnam capacity as well.
Okay. And so one more question. What are your CapEx plans for financial year 25 and 26? Financial?
There's no new CapEx that is there. We have announced CapEx. There is a 50 million this thing in Vietnam and another which is the freeze-dried facility which is already on. And when I say on, the setting of the plant is on. It will be operational from next financial year quarter 2. And the India facility, the spray-dried of 16,000 tons, that's also close to $50 million capex. So that is also ongoing project. And by this year end, by March end, we should be operational.
Okay. Thank you so much, sir.
Thank you very much. The next question is from the line of Rohan Gupta from Nuvama. Please go ahead.
Yeah, hi, sir. Good morning and thanks for the opportunity. Sir, a couple of questions from my side. Sir, first is on the pressure which we have faced on Vietnam with the aggressive pricing you mentioned, which has impacted our margins. This was it was just a one-off, or we see that in our focus on driving the capacity utilization at Vietnam plant to full utilization, we may keep on seeing this kind of margin pressure even going ahead as well. That is one. And second, sir, across the globally, which are the markets you see that US and Europe are still facing pressure where we are not able to push the materials significantly?
So first thing is that, there is a bit of a margin drop because of our aggressive selling. One-off is that terminology may not be exactly right, but yes, it is very short term because once you start building clients and when you start building businesses after you have done your or filled your capacity or optimized your capacity, then you can start kind of, improving on your margins. So because, the more the utilization I get into, my pricing becomes even better because my overheads and all that gets, distributed through a larger volume. So it's a short-term thing. Definitely the margins will catch up. If you see the YTD numbers, the margins are completely intact. It's only in this quarter that we saw a little bit of a stress. Then coming to which markets have been a challenge, I don't see that any markets have been a challenge for us. It's more that we don't have the capacity or we didn't have the capacity to expand to some of the markets. We would have ideally expanded. North America is doing well for us. Africa, small packs, we are doing well. Europe, we are doing well. Even Russia and CIS countries, we are doing well. So I don't see any, and as we discussed and I updated you, Far East, which is including China, we are seeding the seeds right now and hopefully we'll start seeing the volumes coming there. But it was never a question of a demand of our ability. This thing was more of our capacity issues that led to not touching some of these markets. But we are okay to kind of good to go once the capacity is now there.
Sir, second question is on our margins in spray dye. You mentioned roughly 90 to 100 and freeze dry roughly 130 to 135. I think that we were earlier focusing on with our small packs division doing very well. We were looking at $1.5 to $2 margins on an overall basis of the company. So when you think that we will be reaching to those, 1.5 to $2 kind of margin on overall company basis?
We will actually, the exact timing is very difficult because, a lot of work is going on small packs. What happened is that, if you see the pre-COVID time, our small pack ratios really increased to almost 24-25%. Then COVID happened and the small packs really declined, and then we focused more on bulk packs. It was almost, work starting from scratch post-COVID. So now we are back, to approximately 18-20% of small packs as we speak. Once we get into a level of around, 30% or so, then we start seeing the real value flowing into the balance sheet, the P&L. But as I was telling a few minutes ago, is that in the near short term and in the medium term, there are other things which are also playing up. So what is happening is that our spray dried capacity is going up, the mix is changing. So we are selling more of spray dried, which has lower margins. Once the freeze dried comes, then that margins will again start improving. So all this, so there will be certain pluses, there will be certain minuses that will play up, and therefore with the short term, we don't see much of a improvement in margins per se. But what we are definitely seeing is that because of our aggressive top line and volume growth, the driving of EBITDA group, numbers will be through this volume growth. Yeah, and then subsequently, when the next phase comes, we will start driving improvement in margins, and then you will see a lot more improvement in margins, and then we'll see how it goes. Because next couple of years, we are very, very focused that we will drive all our EBITDAs and profits through higher volume growth.
Okay, so commissioning of this spray dry by end of this year will probably may pull down the margin a little bit, but then once again freeze dry commissioning in FY25 may pull up the margins, but for next 2 years at least we are going to see the volume-led growth only rather than any margin expansion.
Absolutely.
Sir, just coming on the domestic business, if you can just share some numbers that the retail sales, sorry if I missed it out, but the retail sales number from the different channels in the current quarter and the 9 months.
So basically 9 months I'll share because that will give you a better picture. So the domestic business in the 9 months is 230 to 35 crores, out of which 140 crores is approximately the retail, the branded business, yeah. And we are looking to end the year, the domestic business at around 320 odd crore. And the brand business will be around 200 crores. So that is the yearly outlook for the brand business.
So any idea if you can just share that in our retail brand at 200 crore, what kind of market share we may have at that number?
Right now we are very small, so our even when Nielsen picks it up, there are errors and all that picking up. But if I see our market share in the South market, which is like 65-70% of the coffee market, as well as the data we buy, so I can share a bit of that with you, is approximately 3.5%. Yeah, and at an all India level, if I were to translate this because I don't have the numbers, so it could be around 2.5%. But definitely there are pockets where we have done, really well. So our market share in, let's say, in AP Telangana would be closer to 8 to 10%. Karnataka would be around 5-6%. Tamil Nadu would be around 3-4%. So that's a little brief on our market share.
Thank you, sir. And just one last bit, and I may come back on a follow-up question. You mentioned that on the debt number that if you don't go for any further capex from here, excluding this $50 million commissioning in over next 8 months to 9 months, if you don't go, then you are going to repay. I mean, the company will be debt free in next 4 years, right? So that doesn't include the growth which you will be doing with the volume led and the working capital requirement, or that includes that, and including the working capital, it will be debt-free?
No, this is term loan, long-term debt is concerned, it's completely debt-free by 29 with a schedule of repayment. And working capital also, we'll have some ease in working capital as well because the free cash flows are going to flow into it.
Okay. So even you are saying that actually from the current growth plans, you can be debt-free, including working capital, I mean short-term, long-term both.
Not debt-free. It's not a debt-free. There is some easiness there from the current level.
Okay.
So long-term debt, it is going to be, definitely it is going to be debt-free on account of long-term.
Okay. Okay. That's it from my side. Thank you so much, sir.
Thank you very much. The next question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hi, sir. Good morning to the team. So one question with respect to the standalone business, we witnessed a volume decline in Q3, but there's a gross profit increase. Any reason for that?
So, there was some better margin business that happened in this quarter. There was a bit of more of small packs that led to kind of, better efficiencies. Therefore, that drop in profit is not there in spite of drop in volume. Yeah.
Okay. And sir, EBITDA margin EBITDA growth has come down. Is it because of the shift in the or delay in the packaging shipping? Because the gross profit has been growth is 17% and the EBITDA growth is negative. So is it because products were manufactured but they couldn't be shipped? Is that understanding correct?
As I mentioned in my opening remark, that there was approximately 800 tons of product which we could not ship because of the Red Sea issue, and during the end week of December. Unfortunately, the Red Sea issue happened at a time when the quarter was ending, so that led to loss in business. So that impacted our P&L.
Okay. One last question from my side, sir, regarding the debt. So you mentioned if there is a no expansion plans in the coming year for the next 1-2 years, then with the debt, long-term debt will be zero by FY28 or FY25. But I just wanted to know if we expand also the amount of cash flow that will be generating will be sufficient for us to fund the capex from that. Is that understanding correct?
Very difficult to comment right now because there will be working capital debt and things like that. So volume will increase. So we'll have to see the situation at the point of time when we are expanding. Will that debt get serviced through our internal cash flow accruals or not?
The reason I'm saying because over a period of time now, as the coffee prices are at a peak, in a 2-3 year cycle, the prices will also come down in the coming year. May not be going FY25, FY26, but they will surely come down. My understanding. So that's why I'm asking.
Yeah, absolutely. So if the coffee prices and all that, they calm down significantly, then, the situation will change. Free cash flows will be far higher far higher in the sense it won't be, but it would be sufficient to not only kind of ease the working capital requirement, but also kind of fund some capex also. So yeah, absolutely you are right. If that happens, therefore the reason we are not commenting is because we really don't know how the prices are going to kind of pan out in the next 2-3 years. Really at that moment, how things are will determine how are we going to fund the capex if at all we decide to.
Yes, sir. And sir, can you talk about?
Can you please rejoin the queue? I request.
Sure. Thank you. Thank you, sir.
The next question is from the line of Kashyap Zaveri from MK Investment Manager. Please go ahead.
Question pertaining to your debt. The interest cost has gone up from about 11 crores to 23-24 crores, in last 4 quarters. One question is that, how much has cost of, borrowing risen by? And the connected question is that, much of this borrowing would be for our expansion also. is how much of even further interest cost has been capitalized in last 12 months or so?
So if you look at it, at Vietnam, the expanded